Hello, Warriors. Well, here you go, Bran. In your face, buddy. How's everyone doing today? Good morning.
Yes.
Good morning, Dale.
Hey, guys, dream team. How's the dream team doing?
Very good, thank you.
Okay, so,
Morning,
here
Dale.
we are. Hey,
Morning.
Stell, Ryan. So, looks like some people want to do a little profit taking in the Euro pre-ECB tomorrow. But, I have a story. Who are this is for Kman and Stelios, okay? So this father was out for dinner with his son, and his son's playing with a quarter, and he's putting it in his mouth and spinning it around. And the father said, "Son, be careful, you could swallow that." And the next thing he knows, his son is choking on the quarter, and he's trying to give him the Heimlich maneuver, and nothing's working. And another guy in the restaurant sees what's going on, and he runs over to the guy's son and kicks him as hard as he can in the nuts. And the quarter just pops out of his mouth. And the father is so grateful. He said, Doctor, thank you so much. You saved my son's life. And the guy says, I'm not a doctor. I'm a market maker.
Nice one.
Anyway.
That's funny.
All right. So, guys, anyway, that's the end of my stand-up routine. And I just want to say hello to our community. And now we're going to get to, what's really happening out there. What do you guys think? Are you thinking more that this is a significant high in the dollar and low in euro? I know we need this to declare it, but would you consider buying some type of retrace of this initial move and risking the lows?
That's a good question. The problem we have is that we have an event tomorrow, which could move the euro above 103.5 or to parity. So, you're taking a bet now on what they're going to do tomorrow.
So but if it's bearish, it could also be maybe negative, but not make new lows. I think it's really the event is whether a retrace holds and we put in a higher low is a ball game to me. How about you, Ryan?
Yeah, it's hard to take what happens right now. I think we've got the ECB. That
Right.
Could be the deciding factor. Are we going to make new highs or lows? It's really down to the fundamentals. This Nord Stream stuff, as we've been saying about, we could break parity again, 99, even further, if the news is all negative tomorrow, or we could be sailing pretty, above 104, 105s, whatever tomorrow, and then you'll think, yeah, well, this is been the top in the dollar. Right here and now, it's hard when you got such an event tomorrow or events tomorrow to say, yeah, this is the bottom for the dollar or the top for the dollar, bottom for the euro in this instance. But the most important thing is not what we think it's top to bottom, it's what the price action does and where we trade it. And we've got two big levels to trade: parity at the moment and this 103, 40, 60 area.
Nothing in between of interest between.
No, I mean I've had a little scalp today just on the back of the Lavrov headlines earlier, which sent us down 50, 60 pips. A little scalp long. Apart from that, I've no interest right now in taking a side here ahead of the meeting tomorrow.
Okay. And we really can't ignore how risk really roared yesterday, can we? I mean, it's a pretty powerful candle. I know it looks like it's not following through just like it looked here, but there's, I saw something from, I think it's Hedgehog, and it talks about the outperformance that Russell, see that, how much stronger it looks than the S&P. I mean, it blew through its 50 days. So it's outperforming. And, if we're going to get that wave, I don't know if it's going to be a failing rally or, the bulls are right for a new high. That seems like, a very aggressive call. But I think the market's really under-owned, a lot of bearishness, and I think the pain trade is still higher on the market because there's no bullishness out there at all. I mean, hedge funds I think had record shorts in S&Ps a week or so ago. So
I'm thinking also, Dale.
Huh?
I'm thinking also, we've got this round of central bank meetings, ECB, obviously Fed next week. And then we get into what wouldn't be a normal summer market, governments on recess,
right.
until later in the year. And, ordinarily we'd probably look for a drop in volatility and liquidity and stuff like that. I think that we might have a risk of having higher volatility, or the lack of liquidity might get prices moving a bit more around the summer, because we still have these geopolitical events. The Ukraine stuff isn't going to pause for a war and they all go down to the beach and build sandcastles. It's going to continue going on. And then we got the gas stuff for Europe. So the data is going to keep coming out. So we could start seeing, quiet moments interspersed with bigger volatile moves around data and stuff. So that liquidity drop. And I think that's
until Labor Day, huh?
Yeah.
We're already we're only 6 weeks away. So yeah, everyone in vacation mode, the doldrums, dog days of summer.
Yeah.
So, okay.
Hey, good morning, guys.
Hey, Blake.
I saw a tweet yesterday that said everybody's bullish because everybody's bearish.
Oh.
I tell you what.
And I was like, that pretty much sums it up, right? Everybody's bullish because everyone's bearish. Because everybody's bearish out there. Everybody's just trying to be a bull.
Look at that. Russell Weekly went right to the gap down here. And look, it's crossing a few moving averages right here. Looks like there's some space. And you were a stockbroker, Blake. The Russell 2000.
We're actually called wealth managers nowadays.
Yeah, but you were,
I was an actual stockbroker like you.
Yeah,
yes.
you were,
yes.
In for the spread on
$300 a day on. Yep.
But you wouldn't. I don't think you'd be short looking at this chart here. But the point is, the Russell's what kind of stock? They're the stocks that aren't making money. They're more spec. They're not blue chips. And if we are going to have a big rally, it would make sense that the most speculative part of the market and not the played out mega caps would outperform because they're the most underowned.
Yeah, so the mid cap stocks. Yeah, I agree with you. It'd be nice if you got some participation there. Some more participation. I'm sorry, Stelios, what were you going to say?
Hey guys, I just want to say one thing. Blake, how you keep asking us every now and then which way you think the next 200 points in the S&P, and I kept saying lower. I think now is the time where we're going higher before we actually then go lower. So I think I think we might reach towards 4,100. In the S&P.
I don't disagree with you. I think today we might make it to 39.40 today. I'm joking. That's less than 10 points away. But one of the things I want to point out here, and Dale, do you mind if I grab the charts really quick?
I'm relieved.
You are relieved. Okay, so the one thing I want to point out is kind of what happened overnight. You'll see this is the descending wedge inside of a long-term channel, which is descending. If you guys and gals listen here daily, you know exactly what chart this is. This chart's been drawn like this for literally months. We have this head and shoulder pattern that eventually makes it down to 3,500, and it's a process. It's not obviously we as we've said for the last several months, we're not going down there in one fell swoop. We're correcting in a very bull trend, and realistically, we will eventually be making it down here. But what happened is that you can see we challenged, these recent highs, and that 3740 level is a big deal. But what's a really big deal is this descending trend line, and we basically just probed it and stalled at it. This is going to be a big intersection for us. We've been talking about it amongst the ForexAnalytix community, and we made a brief new high yesterday, or I should take that back. In European trade, the futures made new highs, and we've slumped back down below, below the breakout point. So you got to be a little careful with equities here. But Stelios, you really think that the next move is going to be to 4,100? Because I don't disagree. I actually agree with that. But that's what you're thinking right now.
Yeah, I mean, fundamentals still point lower in risk, but I think there's going to be some kind of relief rally. Like you said before, the market is going up because everybody thinks the market's going down. So
yeah.
I think there's a higher chance now than there has been over the past weeks. That's what I'm saying.
Well, technically speaking, if we do break out above this resistance, like let's say by the end of today, let's say today we actually break higher, the 4,100 represents the 161% extension of this range. And it also makes sense that we go up there because we did have a false breakdown below the range, if you guys don't remember, at the end of last week, which, false breakouts usually lead to breakdowns usually lead to breakouts. And that's, I think we are realistically headed towards this level over the course of the next, week and a half. But I think a lot of it's going to have to do with what happens with Nord Stream, the ECB, and we're still in the midst of earnings. So if you're talking about equities, so that's a big deal. But that's the S&P. That's our view there, and we do have to be a little careful of this false breakout that happened overnight. That is the one thing that I'm a little nervous about risk at this moment. But one of the other things I want to point out is let's take a look at the euro dollar because we do have the ECB tomorrow. The euro pullback has been very minor. You can see we stalled at the 50% retracement. For those of you that were not in the ForexAnalytix community, I sold all my euros yesterday. That I bought,
nice.
Down here. Thank you. Took all them off the table. If you guys are in the ForexAnalytix community, it's all mapped out in the trades room. This you can see here. Yesterday when I pulled everything off, that's partially some of my positions I took off yesterday. But this is the trades room inside of the general chat room where we talk about what we're doing, what we're trading, and then obviously we have the general chat room and everything else. This is our ForexAnalytix community. But I am looking to reestablish the euro, on the long side ahead of the ECB. The reason why I say that is because I think a lot of this Nord Stream news is factored in the market. Unless we get unless some radical news comes out that Gazprom is just straight up not turning on the Nord Stream pipeline for no reason, which I don't believe is going to be the case. It seems like Putin at this point and Russia will allow Gazprom to open, even if it's at limited capacity. But that's probably due more to a technical error or technical issue than anything. So I think that they're going to let the gas flow. Now the question, like I said, will be what capacity is it going to be? Is it going to be open? So the ECB, I think a lot of people are not looking for a more than a quarter point hike. So as a result, I think that the euro has some upside. I think there's some upside risk that if the ECB does raise rates a half a percent, or if they raise by a quarter, but it's a hawkish hike. What do you guys think regarding the euro? So let's go around the horn, and we haven't heard from Kman yet. Kman, you have any opinions here?
Yeah, I think I will respectfully disagree with you regarding the expectations for the ECB. I think the expectations now for the ECB, or the hopium, is clearly in the 50 BPs.
You think so? Okay.
And if we get 25, this thing dumps.
Okay. All right. Fair enough.
I mean, but I was, if you allow me, I was going to ask Dale. Dale, you said that funds are record short equities. I read something no later than yesterday that positions are at minimal levels compared to prior months and the past year and a half. But did you read?
I believe it was a COTs.
Okay.
So I think it was the commercials.
Okay. Thank you.
But still, I don't think they're record shorts. No, but it's I think it's skewed. So
I think the positioning is record, well, not record low, but lowest in many years. That is
positioning of what? Short positions? Is that what you're saying?
Just
long
positioning.
Yeah. Okay. Yeah. That's what I mean. The market's hardly long. That's bullish if you start getting momentum to the upside. Sure. These guys get paid to be in the market.
No, that's absolutely.
That's all I'm saying.
Thank you.
Same old dribble.
So what you're saying though, and I'll come back to this. What you're saying is you think that the market has now expectations of a 0.5%, and if they come in at 25, the European traders or the euro traders are going to be disappointed.
Yes.
Wow. All right. Okay. Yeah. That's fair enough. All right. Good to know. Ryan, how do you feel?
They'll kick you in the nuts.
Yeah, you don't want to be kicked in the nuts and quarter come out of your mouth.
Yeah, that
was funny, really Dale, by the way. Ryan, what do you think? What do you think regarding the ECB?
Well, just quickly to Dale's joke and the quarter. As a market maker local on the floor, I would have taken the quarter and done a runner with it. So.
Okay, okay. I dedicate that to you too, bro.
Thanks for the call. I'll see you later. Regarding the ECB, yeah, pretty much the same as Kay. There's three thoughts: what they should do, what they've been saying they are going to do, and what they actually do. The market is leaning more for a 50 pip hikes. It was 60% probability yesterday from money markets and those guys who run around with their pants on fire. The OIS stuff was 50%. We've had a hike in the BOE 50-point rate expectation for August at 98% now. And yeah, you've got to look at it day to day these days. What is the real expectation going into the event? And it's that the likelihood is from the market that they hike 50. So the bigger price risk is they don't. So as I was saying this morning on the flow show, looking at the chart, the euro dollar chart, you've got this 103, 40, 60 area. If we're around these levels, 102, 102 and a half, that's going to be your magic number. If we can't break there, that tells you a story. Conversely, if it's negative and we can't break parity again, that tells you a story. It tells you where the market is coming in and drawing the lines. And those are the ones we have to watch and trade against.
So, all right. Well, it's definitely going to be all about price action tomorrow. I agree with that.
Would you buy a retrace if they disappoint Blake and say it pulls back 61.8?
I would. I think if the market let me be a little clear here. If a lot of it does depend on Nord Stream. If Nord Stream it's just not turned on because Gazprom or Russia believes it's just not getting turned on, the euro will crap the bed. Absolutely 100% will crap the bed. But let's just put that aside. And if it's the ECB and we're just thinking about the ECB alone, if they do raise by a quarter, but they leave the door open to being more aggressive, because I think if everything goes fine with Gazprom, eventually that might influence what the ECB does. And when's their next meeting? It's going to be in September. So in September, they might be a little bit more hawkish. And I think that leaves the door open for them. So I would be buying a dip. So if the euro dips back down towards parity, I would be a buyer down there. Like I said, that's not including anything that's coming out of Gazprom, because that can obviously throw a monkey wrench in any decision making that I make. So anyway, those are my thoughts. But let's ask the one of the people that come from a country that always needs money. Let's ask Stelios what he thinks. Let's ask the Greek. Stelios, what do you think? And I'm joking about that, but
about the ECB.
What do you think about the ECB? Yeah.
Well, I've stated my opinion a few times. I think that the time for them has come to do something a bit more aggressive. So I think they're going to do 50, and they have to acknowledge the fact that inflation, no matter how it's coming from or where it's coming from, it's there and it's sticky, and they have to do what they have to do to fulfill their mandate. So I think they're going to do 50, and they're going to be surprise to the hawkish side. So that's my view. Again, though, it's Lagarde we're talking about, so it's a difficult one because she's been as dovish as she can be for so long. But I think really there's no more excuses. I mean,
should we be looking at the TAN indicator?
Yeah. By
like
the way,
if the more remember the Greenspan days, we had the briefcase indicator, Dale. I mean, with Christine Lagarde, maybe we need to start looking at like how damn tan she is. I mean, if she's more tan, that means she's more hawkish, and if she's less tan, maybe she's more dovish.
I think Blake, that will have to do with the fragmentation tool that they are negotiating.
And now that is going to be a really interesting thing about the ECB tomorrow. Let's talk a little bit about that, Kman, because we got to defragment the Greeks, right?
There are rumors going around that she will subsidize the fragmentation tool by selling all her tanning sunbeds, and that should cover the whole lot. Just a rumor,
Just a rumor. Awesome. All right, guys. Enough about the ECB, because we can hash this out tomorrow morning. Ahead of the ECB, we'll be watching price action in the euro. But hey, we got inflation data coming out of Canada here very shortly, in less than 10 minutes. Now I'm gonna start with this, Dale. Dale, what do you think about inflation? Do we give a crap about inflation anymore? Or is it just it's persistently high? Who cares? Like, is it going to be higher? Like, is it really going to matter at this point? Do we care about inflation? What do you think?
Yes, the market's going to get comfortable with that. Oil prices are coming down, copper prices coming down, and they're going to, just like they did in the 70s. There were several false starts. Even Volcker had to tighten twice. So you get periods of where commodities come in and the markets relieve for a while, but it's not the end of the move of commodity markets. Maybe oil, but not everything else. Not wheat.
So do you think the inflation data is going to move the markets today for Canada?
Oh, for Canada, I don't know. I was thinking more like the U.S. Probably. I mean, it's as important there. It's a global thing now. So I'm sure every country in their market and central bankers are living and dying by inflation numbers.
All right. How about you, Ryan? What do you think about the Canadian data today? We're expected CPI data month over month to come in at 0.9%. What do they call their CPI? They don't call
they've got 100 of them. There's the BOC core, the core mean, the core trim, the core
the trim CPI. They do have a few of them now, but the trim CPI, I believe, is like the core, right?
I sell it back at the false breakdown at 131, though, despite whatever data comes out.
Yeah, but that trade's already been there, done that. So that false breakout led to this move back down to the 50%
That's why it's all
retracement.
rally back to 131 if it happened.
Right. Well, let's talk about like importance today. So like the important support, I believe, is 128.50, which is a confluence 50% retracement, 127% extension of that move that spiked us up into the highs. You can see this confluence right here is going to be really important today. But what do you think, Ryan? I mean, if the inflation data is strong, do we get another leg lower in the dollar CAD?
I think it could be potentially very volatile because the Bank of Canada shocked with a 100 pip rate hike, so the market's going to be looking, are we going to get the same again? If they hiked 100 pips on what inflation was last month,
right,
or in the last reading, what are they going to do if this one comes in higher? They're expecting 8.4% versus 7.7%. Year on year in the headline number. What if it comes in at 8.8, 8.9, or have they already front loaded that move with their prior 100 pip hike? But it's going to get the market questioning, is the Bank of Canada going to go big again if the inflation jumps higher? If it comes in close to last month or a big miss of expectations, is that going to reduce what the Bank of Canada might do? It's going to be the same volatility in there as we've seen for the US data. And we know the loonie can be particularly volatile. Your 128.50 might not stand up to much if it's a really strong number. We could be down 127s in a flash.
Let's say inflation data is starting to ease and it's showing up in Canada first before it starts to show up in other places in North America. Could we see a rally back to 130?
That's possible. Yeah, 129's the level at the moment. I've had an old zone sitting there, 129, 131. We broke back below. It's holding 129 straight after that break back down. 130.80 is going to be the number again, and probably into 131. It was the big break point that we were watching for days and days and days. 130.80, and that I expect those sorts of levels to show up again if we get a decent move. But it's one miss on CPI isn't going to change the trend just yet. You need to see inflation trending lower, to get the move. But it's the other thing I pointed out this morning. It's not on CAD today. Isn't following oil. It looks to be like a bit of a commodity lift, FX commodity lift general, but it's not following oil today, so it's off that bus at the moment.
Okay. Stelios, do you have any views on the CAD? Because and before you answer, I just want to say, Dale, one of the questions I'm sure you're going to be asking Luke Groman today, which, by the way, if you guys are sticking around for the interview today, you got to stick around for Luke. He's like one of the best macro guys out there. So make sure you guys stick around for after the inflation data. But you should probably ask him, how important is this inflation data moving forward, based on, and what his views are regarding disinflationary pressures, or is this like a more sustainable trend in commodities? But anyway, what do you think, Stel, regarding the CAD? Do you have any opinions here regarding how you want to trade it?
I think it's driven by the dollar more than the CAD, this pair. We saw that with 100 base point hike, and we're still within the kind of exactly middle of this ascending channel. So I don't know. I think today's CPI will probably beat come in hotter, because that's what's been happening. Oh my God, we're expecting 8.4 up from 7.7, right, in CPI year on year. So I just noticed that, but still, I think it's going to beat. And but we're in no man's land as far as I'm concerned in the dollar CAD.
All right. Well, Kman, I know you've been trading the Euro Canadian quite a bit in the ForexAnalytix chat room. So do you have any view on the CAD here?
Yeah, I'd still be, but we are in the middle of the range in EuroCAD as well, in between 129.90 and 134, well, roughly. I'd still be a seller on rallies somewhere, unless ECB goes uber hawkish. But on the Canada itself, right here and now, not too much of a preference. Really can go either way. Really.
Okay, and you know what? I have zero Canadian exposure. I traded on the short side up here when it looked like it was going to be a false breakout. I traded it very lightly, like last week, and made a few pips, and then I've kind of left it alone. So I don't really have I don't have a view at this point, but I do think we are at some pretty important and pivotal levels. It is still 5 o'clock in the morning here, Dale, for us. So you speak much better than I do at 5 o'clock in the morning. Let me just say that to you, Dale.
Thank you.
He's not. So, we've got data coming out in about 2 minutes. So let's go ahead and get prepared for that. And any last minute thoughts and ideas before the data comes out, you guys?
Don't swallow coins.
What's that?
Don't swallow coins. You get a kick in the nuts.
Ooh, I have one.
Everybody, put your hands, in front of your groin so you don't get kicked in the nuts. Is that it? Sorry, Stelios, what were you gonna say?
Just gonna say don't eat yellow snow. So yeah. Sorry. Yeah. That works well with the girls when you take them up north into northern Greece, right into the snow country. So we got inflation coming out in about 30 seconds. This is the data flash that comes with ForexAnalytix. This is a really nice
tool that's included with the ForexAnalytix service that just, will show you the data as it's being released. Let's see if that dollar Canadian can get below this, pretty key support on some strong data. All right, heads up, data coming out in a second. So
let's see.
Drum roll, please. That's some weak data. Boom, there goes the dollar Canadian up through 129. Look, it's starting to show up.
It's
surprising.
The core number up higher than expected, 4.6% versus 4.2 expected, prior 3.9. Headline inflation missed expectations 8.1, expected 8.4, but last month was 7.7. So still a 4-point jump there.
So we're seeing a little bit of a showing out of Canada. Not a big response, which is unfortunate. I was hoping for a little bit more volatility today. I wouldn't actually mind selling the dollar CAD on a move back up towards 129.50 to 130, but I don't think we're going to see that yet. But anyway, all right. Well, we'll be standing by watching what's happening in the FX market here in ForexAnalytix. But Dale, has Luke gotten here for you?
No, he's not here.
Oh, okay. All right. Well, that's interesting. He's been on with. How many times has Luke been on with you?
Handful of times, I believe.
Yeah. All right. Well, it's interesting to have him not here. All right. Well, while we're waiting on him, any other
Guys,
views?
One thing we could touch upon is what the headlines that Putin said. Oh, actually, it wasn't Putin; it was his minister, right? Who said that the scope of the Ukraine operations could change. Right? Did you see that headline? We didn't discuss that, right?
No, we didn't. I think Kman, you'd mentioned something about that overnight. That's what pushed the euro down, right?
Lavrov said they have changed, not even could. They have.
They have. Oh, they have changed. Yes.
So what does that mean? I mean, does and let me ask you this, and I'm going to ask you guys this, like as from an American's point of view, America, I'm like, dude, he's crazy, and he's going to continue to push and continue to we're far from over. I don't know if anybody actually believes that Putin would call some sort of ceasefire, but what changes here? Like what came out that I didn't know about? And this, because that headline came out when I was sleeping. So guys, please explain.
He's basically go on.
Still.
No, go on.
You had the beginning of this story actually last night during your time, Blake, because the U.S. was it the U.S.
I was having a beer last night.
The U.S. or UK intelligence said that they think that Russia wants to annex southern Ukraine as well, because they want to basically cut off all the exports that Ukraine may be trying to do via seaway. So. Is Lavrov giving the confirmation that they in fact want to do it? It is possible. So in a way, there has been some suspicion already, but it's a little bit of an escalation, which which in turn could put more pressure on EU's supplies, right? So.
It's a threat, right? And it's
a real threat.
There was a headline today. I read that Germany is going to be sending tanks, right? But in 2023, April 2023, or something like that. So not in the immediate future.
The US is also given clearance for these long-range missiles that they weren't allowing the Ukraine to have to target Russian territory, but they're going to allow them to target Russian-held Ukraine territory.
So we have tactical nukes coming here. And Luke Roman is here.
Oh, great.
Okay. Well, I'm glad that Luke is here, and I'm glad he made it. So we're going to I'll have to bow out. But I do want to have this conversation, maybe not tomorrow, but on Friday with you guys. And and this is a serious question. And I want to ask all of you your opinion, because this is not something that we talk about. And Friday will be, I think, fairly slow. Let me just double check that. Well, we will have some
duck and cover.
Retail sales numbers, but I really want to ask you guys, do you believe that World War III has already started? And that's a serious question. I'm not a clickbaity type of question. I want to ask all of your opinions on that. When we reconvene. We'll reconvene tomorrow, but we have the ECB tomorrow. We'll talk about that maybe Friday before the retail sales number. So everybody, I want to thank you all for being here today. I'm excited to have Luke here with Dale because he is, he's like one of the best macro guys out there. So make sure you all stick around. Dale, you're awesome as always. Team, thank you all for all your input today. And Dale, I'll let you go ahead and take over.
Luke, welcome back to F.A.C.E, buddy.
Hey, Dale, thanks for having me. I'm doing great. Thanks for having me back on. It's great to be here.
Yeah, it's great to talk to you. Will you want to go cameras, or it's up to you?
I can do whatever. I can do whatever you prefer.
All right, and I'm ready to ask you some questions about what you've been writing about. So, really, I don't need the chart, so I'll put my camera on and we can talk. Okay, we don't even need charts.
Perfect. Let's see, where am I at?
So everyone, if you don't know Luke, I mean, his reputation precedes him wherever he goes, but he's the author of From the Forest to the Trees. And Luke, I've been reading some of your work, and why don't we start with something that is pretty interesting. You have a piece where you talk about where either the level of Dixie or the level of rates that you believe would cause the Fed to pivot. You want to talk about that?
Yeah, and they really sort of interplay with each other. For me, ever since April 2020, when several Fed members, including Powell, mentioned or used the phrase "functioning," markets functioning. We're not trying to boost the markets; we're trying to keep them functioning properly. Our case has been that the Fed, and probably for longer than this is a practical matter, but the reality is 2020 was the first crisis where the Treasury market ended up crashing alongside stocks for a period of time.
Right. That was unusual.
It was very unusual.
60-40 mix did not work. They got hurt on both sides.
That's exactly right. And that's an Achilles heel of the U.S. financial system. And so since April 2020, we've been talking about a shadow third mandate of the Fed being the Treasury market maintaining function. And for me, maintaining function is basically maintaining that classic 60-40 behavior, so that when stocks are down, bonds are up, and it can be vice versa. It doesn't have to be vice versa. But when stocks are down, Treasury bonds cannot be going down sharply as well. And so that is one trigger I watch for in and of itself. And interestingly, the higher the dollar goes, the higher Dixie goes through the calculation of FX hedging costs for US dollar denominated bonds for foreigners. The higher the Dixie goes, the more expensive it gets to FX hedge dollar denominated bonds, and most importantly, Treasury bonds. And so there gets to be a feedback loop where the higher the dollar goes, the lower FX hedge Treasury yields end up going. And actually, right now they are not only negative for European investors, at least as of about 2 weeks ago, they were the most negative in history. They were also negative for Japanese investors at that point. And so the point here is that the higher the dollar goes, once FX hedge Treasury yields get negative, things start to get really interesting in Treasury markets, and really interesting for the Fed, because we saw this in 4Q18. FX hedge Treasury yields went negative. We saw stocks sell off at the fastest rate, I want to say, since 08 in 4Q18, and Treasury yields just kept rising, and finally they did come in a bit, but ultimately they only came in a bit in the most pronounced way after the Fed was forced to back off of their tightening cycle. If you remember, at the end of 4Q18, the Fed came out and Treasury came out and said the banking system's fine, and then Treasury system. I watch those two very closely because there's an interplay with each other. The higher the dollar goes, the more stress there is in terms of reducing the foreign bid for Treasuries at a time where that stronger dollar is also having the impact that we've been having at sea, which is risk off. And slower global economy, lower tax.
Could that have manifested, Luke, right here at 350 yields and 98 in the Dixie?
I think possibly. I mean, now,
Okay.
May, I'm looking at the chart here. May, you're seeing that foreign private demand for treasuries was the strongest on record. So it looks like once it hit that, that's what am I looking at?
350 level on the 10-year?
Yeah, on the 10-year, it looks like there was a bid in May from the foreigners that brought that down. But then as you see it sort of went right back up. So they don't tell you when the foreign private sector was buying all those treasuries. Looking at that chart, if I had to guess, it would be in those red candles is when the foreigners said, okay, 3-2, we're going to load up here. But I think it was critical. You saw it went right back, right? There's this upward pressure on yield because of these factors that I'm talking about here. And
it would be pretty counterintuitive to expect the 10-year yield, if it takes out 274, 272, that's going to be pretty negative. It could take it down to 220 or so, Luke. Yep. That it would do that in front of a Fed meeting next week. What are your expectations?
I think they're going to do 75 basis points next week. I think it's the wrong thing to do. I think
you're a Fed chairman. What would you do? I'll vote for you, Luke.
If I was Fed chairman, if I couldn't resign, I would have resigned 12 months ago.
You didn't even want the job.
Especially if I was worth $100 million like Powell's reportedly worth too. I wouldn't need this.
Yeah, why isn't he relaxing?
Seriously. But if that wasn't an option,
yeah,
I'd probably do the 75 real quick and be done with it. I think it's a mistake but I think it's the least mistake. And it buys him it buys him some time, which I think is probably more important. And the reason I say I think it's a mistake is I am hearing the economy took one big step down in May. I'm hearing in real time the economy is rolling over hard now. And while the Fed is busy looking at unemployment, which is a it's a lagging indicator. They were looking at employment last year while they were saying inflation was transitory. They were wrong. They're looking at unemployment now, saying we can do another 75 or 100. The economy's rolling hard. They're wrong. But that's why I say it does buy them some time and some room to then reverse themselves, which I think the 75 they do, if they do it next week, I think that'll be it.
Okay. Risk is acting that way. But this week we have another real important central bank in focus, the ECB, and you're talking about game theory in the EU, that they're repeating the same mistakes they did going into the Weimar Republic and hyperinflating. You want to tell us what that game theory is?
Yes,
that you speak about.
Absolutely. So it's something we've been writing about for the last 3 or 4 months, which is
Luke, I just have to stop you because I say it all the time. Who is we? Who is we?
Who is we? It's a force of habit. Me. It's me and my team. I do all the writing.
I know. Sometimes I think we have, a split personality.
Exactly, right.
Yeah. Yeah. Anyway, well, we is doing a good job. Go ahead, bro.
So what I've been writing for the last 3-4 months has been the European policymakers are running effectively the same economic playbook that the Weimar German government did in the aftermath of World War I, which is short version is after the end of World War I, the French seized Ruhr Valley coal stores as war reparations. The Germans weren't paying fast enough. French marched their army in and occupied the Ruhr Valley. Would not
energy
let that
crisis.
Energy crisis. Exactly. So and so the Germans said, well, we don't have enough energy. Let's just print money. And when you start printing money to try to paper over an energy crisis, you end up with accelerating a runaway inflation problem. And if you just keep doing it, you will eventually end up with hyperinflation. I don't think the Europeans will hyperinflate because I hope they're smarter than that.
They have a memory.
They have a memory, the Germans in particular. But you're seeing symptoms of that, right? In the last 3-4 months, we're seeing German PPI at 30% or whatever it is. Now you are seeing this in the last week, this ECB a periphery bond facility that they're intimating has no limits on it, where they are going to quote unquote buy periphery bonds so that they so that those yields better reflect economic fundamentals, which is an absolutely silly statement in my view, because they're the fact that they're widening are the economic fundamentals. They don't have enough energy. They are in an energy crisis. The creditworthiness of the periphery is deteriorating. So they are literally doing the same thing the German government did in the aftermath of World War I in the Weimar Republic, which is they have an energy crisis based on their going along with U.S. sanctions on Russia, and now they're printing money over to try to paper over, keep nominal economic growth going as if they don't have an energy crisis. And so until if they keep doing this, one of a couple things is going to happen in my view, and I think it's going to happen in the second half of this year. Either you're going to get a disorderly collapse in the euro, and I think we saw hints of that over the last couple of months, what that could look like.
Yeah, there's a chart.
Or you're going to get one of two, and interestingly, I think people are positioned for that option. There are two other options nobody's positioned for, in my view, or very few people, which is number one, the Fed comes in and starts buying euro debt. They start.
I was going to ask you about that,
which they can do.
Yeah, you said Bernanke set that precedent.
Yeah, he hasn't done it, but he let Bernanke in his famous deflation, making sure it doesn't happen here speech in December 2002, explicitly stated the Fed has the legal authority to buy foreign government debt. So that would just be effectively a currency intervention where Fed buying euro debt, or they could do this for Japan as well. So that's an option, I think, if the dollar gets strong enough, if the euro gets weak enough, in other words, that the Fed could do. Alternatively, I think if the U.S. refuses to do that for its allies, then I think we'll see ultimately realpolitik dictate that the Europeans turn back to Russia and say, okay, I'm sorry, we were wrong. Can we buy energy in euros? Or can we buy energy in rubles? And you do whatever you want. We will sign a deal. And that, I think, will completely start to reorder the global geopolitical balance. I think that would have important implications for FX markets, risk markets, et cetera. And those are pretty broad ranging. But I think those two options are way more likely than people think, given that everybody's too strong. But consensus right now seems to be positioned for basically Armageddon in Europe.
Yes. Yeah, you can't find anyone bullish on Europe, and
included.
You know that what bailed them out for years was trade. Yep. And you would think with a weak euro, that would have been able to help. So you also talk about that, having a weak currency isn't as advantageous as it used to be if you have an energy crisis.
If you have an energy problem. I mean, you just saw there was a chart on Bloomberg the other day showed that the Germans actually ran a deficit for the first time since '91 because of energy. And that takes away the entire trade balance, right? So their current account surplus, largely generated by Germany, is now a deficit. Right. So now they're a twin deficit nation like the U.S., except they don't have the global reserve currency. And so that currency is going to go down and down and down until either it collapses or the
U.S. steps in with the. Are we talking a Plaza Accord type of thing here? Global. What do you think?
I think yes, and I think it's really important. You were showing that euro chart a little earlier.
Here it is.
That it bottomed on July 15th and started rising. Yeah. I did not realize this, and I'm as deep in the weeds on this stuff as anybody. Did you know that on July 15th there was a G20 finance ministers and central bank central bankers meeting in Bali that Yellen was at? I didn't know until someone pointed it out to me on Friday night. And so it's interesting. July 15th is Friday. The euro dollar's been straight up since then. And so my point being that I don't want to get crazy and play 5-minute macro.
Yeah.
But you have a G20 that's not that well publicized, or certainly that sort of FinTwit and CNBC were not pumping all over. As being a big deal. It was sort of on the QT, and since then the dollar's been the euro's been a one-way trade against the dollar, straight up. So maybe, maybe there's an intervention that's begun. Same thing. Look at the yen, right?
Yen,
yeah.
right.
Same, it's since yen's flat. So yen's down a little bit, flattened down a little bit, but risk assets are up since then.
It's not flat though, but longer term.
Longer term. Oh no,
and you talk about the problems in Japan. You want to expound on it?
Yeah, it's the same problem that Europe is having. It's an energy crisis, and an energy crisis that, back in April we pointed out it put them into a current account deficit position, and as soon as they go into a current account deficit, they're running twin deficits without the benefit of the global reserve currency. Now it's and basically starting right where that chart broke out to the upside, right, with the yen deteriorating against the dollar. Kyle Bass's 2013 short the yen case finally came to life when they went into a current account deficit because of the energy crisis. And interestingly, because Japan owns $1.3 trillion in treasuries, $2.8 trillion in dollar assets in total on net, the 10-year treasury yield has been basically tied at the hip to the yen for much of this time. So the lower the yen goes, the higher the 10-year yield goes.
They've been pretty married, except I would say that the yen kind of found a world of its own, like Rod Serlingville, compared to here's a 10-year. So they're going in different directions here. So, if we do break down here, that would probably also help if they could break the yen, strengthen it, that yields might fall.
And that's exactly what I think.
The playbook, bro.
That would be the playbook, right? And we've seen, you never believe anything until it's been officially denied. You had the Yellen saying a couple of weeks ago that they were not discussing supporting the Japanese government bond market with the Japanese government.
Methinks thou protest too much.
Yeah. So there is some level of knowledge about that, discussion about that. So let's see, because I agree, if you get the yen to weaken, you get yields down, you get the yen to strengthen, you get the dollar to weaken. The dollar to weaken gives everybody.
Get oil to break down, Luke, under 94 this time. They saved it once. Could they save it again?
I think that might be the key linchpin, right? And one of the things that makes this whole environment much more complicated is I think the Fed might have already pivoted, given what we're seeing in some of the sequential readings, except for the fact that I think they know when they pivot, oil's going to go up, and if oil goes up, Putin wins. So sort of in their minds, to oversimplify. So I think they'd love to get oil down. I don't know that they're gonna be able to get it down a whole lot more. I mean, down you're whatever, 120 to 98,
94 to 125, right in here.
Yeah, but it's going to be really
technically under 94, and this is the 50-week moving average here. Could open the door for 80 or so.
Yeah, I agree with that. And the challenge, when I say they can't, of course they can. When I say they can't, I should caveat that for the reason I say that is the amount of economic demand destruction needed, in my view, to get oil down there will reverberate in tax receipts for the U.S. government, and as a result, the Treasury market much faster, and it'll effectively accelerate a balance of payments problem for the U.S. As well as for the U.S. basically, right? Because
so let's wrap it with it. You talk about receipts, and I think you were talking about were you talking about just one state or the U.S. that and gross tax receipts are down 33%?
Yes, New York City last week came out and said that their estimated payments for June were down 31% year over year already, which was exactly what we've been looking for, which is obviously New York City is highly tied to the stock market and to asset prices, but the U.S. economy more broadly, on maybe only a slight lag to New York City, is tied to it. You just saw yesterday California housing sales down 21%. that's what happens when you take away NASDAQ collateral and you raise rates a little bit. And I guess you've raised rates more than a little bit, to be fair. But the point is you start taking housing sales down 21% on top of NASDAQ down 30%. California is going to be next in the tax receipt collapse spanking machine. And the U.S. government will be a month or two later, and your structural payments, entitlements, defense, treasury spending, they don't go down, they only go up. And so if your receipts go down,
right,
it's not going to take a very big decline to put those big three. Well, they're already more than receipts, but you start taking receipts down 10-20%. You're going to need to increase treasury issuance non-linearly in the third quarter at a time where Japan's selling, China's selling, Germany's selling, foreigners are, the foreign official sector is selling, and FX hedge treasury yields are now very, very negative. So you basically have to convince the global private sector to take, in Japan, -1% after FX hedging to own U.S. treasuries on an annual basis. And they might be more inclined to just buy JGBs yielding whatever, a quarter basis point. And so you start to see private sector selling of treasuries too globally. And that's why I said it'll start to reflect pretty quickly in a balance of payments problem for the U.S., because then you're going to be having U.S. treasury yields go up in a recession.
Yeah. So, and it's basically because there's not enough demand to roll over the debt.
Yeah, it's ultimately the Fed and Treasury are withdrawing liquidity. U.S. Treasury outlays in the third quarter are the biggest year-over-year decline, in the second quarter, biggest year-over-year decline in decades. It's coming off a very big high, so you have to put a little bit of an asterisk next to it. But look, federal government is 22% of GDP. 22% of GDP is down 20% year to date on a trailing 12-month basis. So that's a 4% headwind to GDP, and GDP fell, I think, 5 in the Great Financial Crisis on a 4-year.
So is the market betting the way risk has been acting, Luke, especially the more spec end Russell beginning to outperform even the S&P and NASDAQ? And that's kind of the trash, the Russell 2000 compared to, the old mega blue chips. Is risk saying that perhaps the market's going to think the Fed has it right for a while and risk continue to act okay?
I think it's starting to reflect how quickly the economy is weakening, and that this might be the last hike for the Fed. Okay.
And if you were Lagarde tomorrow, what would you do, a quarter or a half?
Probably a quarter, but they are really at the mercy of the U.S. at this point, because your PPI is your PPI is 30% in Germany. Like does it really matter, quarter or a half? Like you should be raising them 20 points. But you can't, because you'll blow up the world. So
the Fed has to be the messiah, financial messiah here for central bankers.
I think so.
Okay, Luke, and tell your son he's got a great swing, and really appreciate you coming here and sharing your ideas, Luke. I learn every time I talk to you. I'm sure everyone.
Thank you very much.
And now I know that I'm not the only schizophrenic guy that says we were saying last week. Right, buddy?
It's a force of habit from working on the sell side for so long, right? It's never I, it's always we. So it's,
I know. And I also, just before you go, I just want to show, where people could find you. And, it's the Twitter's at Luke Groman, but here's Luke's website. And his writings, I see him, and they're great. And he does videos, and really, if you like Luke's analysis of, seeing the forest from the trees, check him out at FFTT-LLC.com. Thank you, buddy.
All right. Thanks for having me on, Dale. Take care, everybody.
Right. Appreciate you, bro.
Have a great day.
All right, everyone. That's a wrap. And you could join the team in 20 minutes on the Morning Edge. Hope you enjoyed it. And we'll see everyone for tomorrow's session. Good hunting. Another one of my long goodbyes. Don't just count your pips, count your blessings. Adios.